All right, we can go ahead and get started. Welcome, everyone, and welcome to the Tippy webinar series. My name is Ashley Durham, and I am the Director of Alumni Relations at the Tippy College of Business, and I'll be your moderator today. This series is an initiative of the Alumni Relations Department at Tippy. Our goal is to bring the knowledge of our faculty and staff to you wherever you may be in the world. I would now like to introduce Interim Dean Amy Christoph Brown. Thank you, Amy, for being here this morning or this afternoon.
This afternoon only by 1 minute,
Yeah.
but thank you, Ashley. Thank you all for joining us today for our session. I know that you will enjoy it. Dr. Richard Peter is a fabulous presenter, and I attend all of his webinars whenever I can. We thank you for being here today, and in the future, keep looking for what we're sending in terms of our alumni webinars. We have one coming up December 9th, and it will be on the sports industry. We'll have several alumni speaking from areas such as the NFL, the NBA, and the U.S. Tennis Association. Alternating with our alumni panels, we'll have our faculty speak to you about different topics where they specialize. So thank you for joining us. We love that you stay connected with us, and we hope to keep bringing you ideas that you're interested in and spending time with us so that you know more about what we're doing here at Tippy. Thanks so much for joining us. Ashley?
Thanks, Amy. I'm now excited to have Richard Peter, an associate professor in the Tippy College of Business Department of Finance, here to help us take a deeper look at what research tells us about how consumers make insurance choices and what we learn from those choices. A few housekeeping items before we begin. You can submit questions to us through the Q&A panel. Just click the Q&A button on your meeting controls to open it, type in your question, and click send. Ask questions at any time. We'll collect these and address them during the Q&A portion at the end of the webinar. I would now like to introduce Richard Peter. His research interests are in the areas of risk management and insurance and decision making under risk and uncertainty. His work has been recognized with numerous awards, including the Early Career Scholarly Achievement Award from the American Risk and Insurance Association and the Tippy College's Early Career Research Award. Originally from Germany, Richard holds the Cannon Scholarship for Teaching Excellence and was named the TriStar Fellow. He joined the Tippy College of Business in 2015. Richard is passionate about the research he does, and we look forward to having him bring his expertise to us today. Thanks so much, Richard, and go ahead and take it away.
Welcome, everybody. I'm really glad to have you here and to do this webinar with you today. Thanks to Ashley and thanks to Amy for the kind introduction. It's much appreciated. And let's jump right in. So we're going to talk about insurance demand, some pitfalls, how do consumers make complex insurance decisions, and what are some of the mistakes or the errors that might happen in that process and how we can avoid them. So it says some lessons from decision theory, and I'm really excited to have the opportunity to talk about my research and share some of the insights that come out of that research with you today. So once a year, what happens once a year? There's many things that happen once a year: birthdays, anniversaries. Fortunately, the presidential election does not happen once a year, it's every 4 years, right? So there's a lot of nerve-wracking stuff going on. But we will have a topic today that's at least as nerve-wracking as the presidential election, and that is insurance choice. And what a great time to be talking about this. It's November, and for many, this is open enrollment. So you might be thinking about benefits, options that are available, choices you might be making for your benefits. So let's take a deeper look at how people make those choices and what some of the problems are that arise in that decision-making process. And first of all, just out of curiosity, I have a question for you. So have you made changes to your benefits this year? And Ashley is going to help us collect the answers by bringing up a poll for everybody to consider. So let's take a look at the answers. I'm curious. I see 70% no, 26% yes, and some people haven't thought about it yet. Maybe the no's, maybe we will turn them into yeses. Maybe the reason is you're not really sure what you should do, right? There's a fair amount of confusion around insurance. So I think it's great that you're joining us today for this webinar so that we can learn more about how people make insurance choices. Before we dive into that, I want to talk more generally about my research and the types of research that are done in that field. So there's people who work on the theory side and they build models of decision making under risk and uncertainty and what models can teach us about consumer behavior. And there's also people who work with data who look at experimental setups where we have controlled environments and we gather information about how people respond to incentives, how they think about risk and return trade-offs. We have people who work in the field who look at insurance demand in the field, how people actually make these choices when they think about different plans, different plan features, what attracts their attention, what are important features and what are the things that they might be neglecting. And people work with surveys, so there's a whole variety of approaches. What I do in my research, I'm heavily invested in the theory side. So I work with models and what models can teach us about decision making under risk and uncertainty. And just to clarify, so I'm an applied theory person in risk management insurance. I develop models of choice under risk and uncertainty. So you might be wondering what are the kinds of questions that these models can help us answer. So I brought some examples here in today's webinar to give you a better idea of what that means and what the types of questions are that I'm working on. So they might be descriptive in nature. So we might be observing certain patterns, how people choose benefits, how people make insurance choices. And then we might wonder, how can we explain those choices? So we might build models that say, okay, this is how we can rationalize these choices make sense. Or maybe not. We might also find maybe there's a mistake, maybe there's room for improvement, maybe people may not be making choices that are in their best interest. Models can also have a predictive nature. When you develop hypotheses, you might want to know, okay, what happens if people have better information about effectiveness of risk management, if we learn something about the benefits of face coverings and face mask wearing to slow down the spread of a pandemic, how should that affect behavior, adoption of masks and safety investments? These models can also be used to answer normative questions. For example, should we be doing certain things, or how should we design certain insurance products or certain markets? For example, should we allow life insurance companies to ask for genetic information when people ask for policies in the underwriting process? Is this a good thing or is this a bad thing? How should we think about that? And I've also done some work that looks in the methodological side, developing new methods to that allow us to analyze the effect of, let's say, preferences or people's beliefs, people's perceptions on their behavior. So a whole host of things from a top level view, from a top level perspective. What that actually means in practice, so I'm in my teaching semester right now, so I spend a lot of time with my students in the classroom and helping them on Zoom or in office hours. But spring is always devoted to research for me. In practice, what that means is I build theory models, so you can see big paper clutter here, and I number the pages so that I can get it all pieced together in the end. I solve models, and a lot of that is really on pieces of scratch paper, so it's really old-fashioned. We write papers, we document our research findings, and then we publish those papers. So the example that I pulled up here is with a colleague from Munich, and she will be joining us in the fall as a new risk management insurance faculty here at TIPI. So I'm also promoting her research. And this is something that we're currently working on. So there's a publication process in place. You send out your research papers, you get expert feedback on those papers, and then you revise, you revamp, you improve it, and then things get published and circulated within the research community, and they can help inform research and practice of risk management. So I'm really glad to have this audience today to be able to share some of these insights of the research community with you. All right, so much about the little intro. What's the research all about? Now let's jump into the topic of benefits. And there's a whole host of benefits. And when you open the open enrollment, let's say for Iowa, there's health insurance, there's dental, there's flexible spending accounts, there's life, there's accidental death and dismemberment, long-term disability, sometimes long-term care, and others. So there's a whole variety of different benefits, and people might find it overwhelming. We will start with an important one, which is health insurance, health plans. And the first question is, where do Americans get health insurance? And we can see there's a variety of segments. We have employer-based health insurance as the majority. We have Medicaid and Medicare. We have the non-group segment, other public, and then also a population of uninsured individuals. And in a variety of these segments, people make choices. Employer-based health insurance, we can choose between different plans. Here at Iowa, there's the choice between UI Select and UI Choice for the two plans, so faculty and staff will know about that. Also, when it comes to Medicare, there's enrollment choices. And in the non-group market, if we think about the healthcare exchanges, people make choices. They compare different plans and they choose plans. So it's something to consider. How do we make these choices? Before we move on, just out of curiosity, I have a question for everybody. So where is your health insurance from? Just so that we get a breakdown here in this crowd who's joining us today. Employer. Perfect. This is perfect because this is where you make choices, where there's different plans offered, and you have to think about costs and benefits. So this is a great answer. You can see America overall looks a little bit different from this poll, but these health plan choices also matter in other segments, but they matter especially when it comes to employer provided health insurance. So this brings me to my next slide. All right, employer provided, as we said. So if people make choices, do they make sensible choices? Okay, and this is from a study that was published a couple of years ago, 2017, and I was not one of the investigators, but it relates to some of the research that I'm doing, and I will show you how it's related. So they were looking at health plan choices of employees at a Fortune 100 firm that remains anonymous. And the idea was people can build their own health plan one feature at a time. So the idea is to give employees a variety of choices so that they can build a health plan that best fits their needs, that gives them a lot of discretion, a lot of flexibility to build something and put something together. Now, there was no difference in network coverage or the reputation of the insurer, so that was all the same. But there were differences in cost sharing arrangements. So people could choose out of 4 deductibles, $1,000, $750, $500, $350. Just as a reminder, the deductible is what you pay out of pocket before the insurance covers. Then there were different levels of maximum out-of-pocket spending above the deductible. This is where your spendings are capped. Once you're at the maximum out-of-pocket, then it can't be any more than that. There were co-insurance rates above the deductible. So if there's payments above the deductible, the insurer only covers a certain percentage, 80% or 90%. The rest is out of pocket. And then different types of office co-payments, $15 or $40 for primary versus specialist. And other plan option was 25 versus 35. So there was a whole variety of options that people had, and they could choose plans. Now let's look at that. And now I'm going to have a little task here. So you might say, oh, this is back to school now. Is this a math problem here? But this is a task that the employees faced in this company. Choose a plan that works for you. So we have one plan here, $1,000 deductible, 80% co-insurance, $2,500 maximum out of pocket, the co-pays here, and then the monthly premium. Plan B had a lower deductible, higher co-insurance, lower maximum out of pocket, different co-pays, and the monthly premium. Then there's Plan C, $500 deductible, it's an 80% co-insurance, $2,500 maximum out of pocket, and here the copay was $2,535 and a monthly premium. And then there's also a Plan D. Now, this is not the full set of all possible combinations, but these were plans that were fairly popular at that particular firm. Now, I hope I get away with that. This is a mean question, right? I'm only going to give you 1 minute to think about that. And obviously, I want you to think harder when it's for real, when it's about your benefits. But think about it and tell me which of those plans, plan A, B, C, D, is the one that you would choose. Let's take 1 minute to think about that. All right, it looks like the results are in. That's interesting. And so honestly, you guys are doing great. So there was, and I have to write that down for myself, 86% choose the high deductible plan, 23% choose B. Then we have 9% of individuals who choose C, and nobody wants plan D here in our webinar. So this is great. So thanks, Ashley, for showing us these results. I will tell you what happened at this company. So at this company, when employees built their plans, C was the second most popular plan after the default plan. Here it comes out different. So here lots of people like A a lot, and then some people like B. And C, we have like roughly 9%, or let's say 10% of people who like the plan C. So let's take a deeper look. How can we think about these choices? But remember, at this firm, plan C was actually really a popular plan. Okay, now let's look at these choices. The first thing that I did is I have annual premiums here. It's going to make it easier to do some comparisons. And now let's look at A versus C. You can see, well, the only difference is the deductible is different. So if you go from A to C, you have $500 more in coverage because insurance covers earlier. Now, if you look at the premium, also the premium goes up with the higher coverage. It goes up by almost $600. So the extra coverage is less than what the extra premium is. So we would say C is actually not really a good choice. These were real choices. So these were choices that employees had at this firm and they chose for real, right? So this is not hypothetical. These are real choices that people made at this firm when they choose their health plan. Now let's look at B versus D. And here in our webinar, nobody chose D. And it's a similar story. So the deductible is lower. So we have $400 extra coverage. If we're looking at the premium, then it's almost $700 more in premium. So we would say plan D is actually not a good choice because the extra premium that we pay is more than the extra coverage that we're getting. So against the background of our little analysis here, plan C and D are dominated. And I'm actually really impressed with the crowd here in our webinar because most people stayed clear of those plans and chose higher deductible plans. Now in the full set of plans, also that plan B here was dominated in the end, and only the high deductible plans in the end were not dominated. We'll come to that later. So let's take a look at what people actually did in that firm when they made those choices for real. It wasn't hypothetical, it was real dollars, it was real cost sharing arrangements. Out of the plans that were offered, 35 were dominated, and 60% of employees chose plans that were dominated. Like in this example, if we go back, plan C and D were dominated. So 60% of employees made a choice, they chose a dominated plan, like C or D in the example. 55% chose dominated plans, even if we take taxes into account, if we think about how premiums are handled from a tax standpoint, how out-of-pocket expenses are handled from a tax standpoint. So the majority of employees, they choose dominated health plans in this firm, and they do it for real with the full consequences. It was not hypothetical, it was all real dollars, and that's what we see in the data. That's what the research tells us. You might also wonder who is most affected by that, and as it turns out, in that particular firm, people with a lower salary at the lower end of the salary distribution were much more likely to choose dominated plans by a factor of 1.6. These are also the folks who would have benefited most from choosing to a better option. And then there was also elderly employees, employees with chronic conditions. They were more likely to select dominated plans. These dominated plans, they all had lower deductibles. So that's consistent with the idea of adverse selection, because these are employees with higher health risks. So they might think they get good value out of the extra coverage if they choose the lower deductible plans. All right, so that's what the data tells us. And now from a research standpoint, if we're thinking about consumers and behavior, that's a little bit frustrating, right? We want people to make good choices. So where is this coming from, okay? And this is where the theory comes into play. So if we look into the data, we can see who makes which choices, what are the things that people choose. And now we want to know, how can we understand that? How can we rationalize that behavior? Are these people actually making mistakes here? Is this a true preference? Is something driving that choice? How can we understand that? How can we dig deeper? And there's several thoughts that we might have. We might think maybe it's a risk aversion thing. If you have a lower deductible, insurance covers earlier, you shift more risk to the insurance company and retain less risk as an enrollee in that plan. So maybe it's just a risk aversion thing and we shouldn't be concerned about it. Or it might be related to people's beliefs or expectations. They might overestimate the likelihood of needing care or the cost. And for those reasons, they say, okay, maybe this makes lower deductible health plans a better choice for me, given my situation or given my health history. So let's take that apart. And this is where, as I said, where the theory comes into play. And let's look at some other contexts. So people have worked with risk aversion and tried to use risk aversion to explain insurance choice in other contexts, for example, homeowners. So that's going to be a next choice, a next thing to think about. Let's consider different deductibles in homeowners. Let's think about a house located in the Midwest, built in 1975. Insured home value is $200,000. There's different deductibles available. You can see there's a higher deductible, then there's a $1,000, $500, $250, and $100 deductible on those property damages. And you can also see the different premiums. Obviously, premiums are higher if you have lower deductibles. So let's ask our audience here, out of these 4 plans, which plan would you choose? And thanks, Ashley. So let's take a look. We have 60% with the high deductible option, and there's 30% for the $500 deductible. And there's, let's say, for the even lower deductibles, it's among the 9%. So that's what we see here. Now let's take a look at how we can break that down. So which option would you choose? We answered that. How should we think about that? Let's do some comparisons again. Think about the extra coverage relative to the high deductible. If you go from $1,000 to a $500 deductible, it's $500 more in coverage. If you compare the $1,000 to the $250, it's $750 more in coverage, etc., etc. So we can compare the relative value. You can also look at those premiums and look at the relative cost. Relative to the $1,000 deductible, here we almost pay $100 more in premiums. If we compare option 3 to option 1, you pay $186 more in premiums, etc., etc. So while there is no dominance here, right? So the extra coverage that you get is greater than the extra premium. If we're just looking at options 1 and 2, we still might be wondering, well, is it worth it? So no dominance here, but is it worth it? Let's look at claims rates. On typical policies, a claims rate is in the ballpark of 4%. So the extra coverage of $500 here is worth an expected value of 20 bucks, you might say, but you will be paying $100 more in premium. So against that background, it doesn't seem like an attractive deal. And again, the high deductible plan seems like a really reasonable option. People have tried to explain a preference for lower deductible plans. So in typical data sets, the $500 deductible or something here in the middle is much more popular than the high deductible plans. People have tried to explain that with risk aversion. It's difficult. You need a lot of risk aversion to justify that choice. There's models that also look at probability distortions. Maybe people don't get the claims rates right, and they have different ideas about how likely it is to be using the extra coverage. If you use those models, you can get more mileage out of it here, but they create challenges in other scenarios. So that's a paper that I wrote with co-authors where we say, okay, these models, they might help here for deductible choice, but they create all sorts of other problems if we're looking into areas where people choose too little coverage and not too much. For these small risks, right, the deductible of $500 versus $1,000, it's not really worth bothering. You should rather budget accordingly and be in a position to retain any losses up to the deductible and cash in those premium savings. And each and every year you don't have a loss. So that's a smart way to save money on insurance. Risk aversion doesn't really help here. Now let's look at something with beliefs and expectations. And there's research that shows that this plays a role in areas of insurance demand related to, do people take up insurance? For example, they might be uncertain, is the contract actually going to work out? Is it going to perform accordingly? Am I going to get the value out of it? If they experience that uncertainty, it might lower demand. And there's also recent research that shows this might be especially important when it comes to annuitization and saving for retirement. Even the highest rated life annuity providers, they have a positive level of insolvency risk. And people might be unaware of state guarantee associations that might jump in when insolvency risk materializes. And insurers are actually not allowed to advertise these state guarantee associations because regulators are concerned it might undermine their incentives to invest in their financial strength. So educating oneself is costly. Another area where beliefs or people's mindset plays a big role is that area of trust in insurance. And there was recent research into the determinants of that. Who are the people who have more or higher trust? What's the role of education? And especially also what's the role of experience? And that brings me to my next question. So have you ever had a bad experience with insurance? Or do you know somebody who did, just out of curiosity? So maybe let's take a look. I'm really curious now. So 69% says yes, 2/3 say yes, 33% say no. That's really interesting. And for me as an insurance professor in the field, it always breaks my heart when I hear that, right? Because insurance is a great industry with lots of opportunity. Insurance is a great product. If we bear risk together, if we form a pool of risks, we can create a lot of economic value. So it always breaks my heart when I hear about that. What's the broader evidence on that? There's a recent survey, and if we're looking into the US, it's fairly comparable to what we see in the survey. So 63% of people report they've had a bad experience. What's the nature of those experiences? And keep in mind, these numbers here, they're not adding up to one, so people can have multiple. Lots of people say they got a claim denied or the payment was delayed and that was frustrating. Some people also said they had difficulty to claim or the purchase process was really complicated. So there's a fair amount of frustration, okay? Now let's try to connect that back to our question about these health plan choices, how people make decisions. Risk aversion, beliefs, expectations, and trust. Can that help us explain what we see that people prefer those dominated options? The answer is negative. It doesn't help in that particular context. Risk aversion or beliefs cannot explain this preference for dominated health plans. And I brought a chart here that's going to help you see that. Now, you might complain about my chart. It's another chart where we have something in blue and something in red. And we've been seeing a lot of these charts lately, so you might be getting tired of it, but hang in there. So what I have here is annual medical expenditures. And then on the y-axis, we see premiums and then the total out-of-pocket expenditures. And I do this here on the nominal basis. We could also do it tax adjusted. It would look very similar. And we can do that for Plan A, and we can also do that for Plan C. And then we see, regardless of where we are in our medical expenditure distribution, we always have a higher cost with Plan C than with Plan B. So regardless of what you think about your medical needs, what beliefs you have, regardless of how much you trust your insurer to handle certain claims, regardless of how sensitive you are to risk, none of that can really matter here. None of that can explain that pattern that lots of people actually in that firm did like Plan C better than a lot of the other plans. Now, my question for you, once we look at this chart here, do you find it easy to see that A is a better plan than C? Let's have our next poll. Let's take a look. 84% say yes, 16% say no. So for the majority of people, the graph really seems to be a good tool. There's other people who still have questions, so who might be thinking about plan choice in a different way. We will have time for some questions at the end. I'm really curious to hear your perspective and to learn more about that. Now, we said risk aversion and beliefs, that's not going to help us here. What about other potential explanations for the preference of dominated plans or these choices that we see? Is it simply complexity? Is it that there's too many options? And in one of the title that was circulated, it said spoilt for choice. So that's a standing expression in Great Britain. That's just too many choices and you're overloaded. It's hard to process and you don't really know how to sort through. There's too many plan features and that's simply something that might be confusing people. Or do people have different preferences? Maybe they evaluate costs and premiums differently, right? Maybe they matter along different dimensions to these decision makers, these employees in the firm. It might be related to liquidity, to budgeting, to psychology. Or is it a problem of insurance competence? Is it that insurance is hard to understand? If you read about deductibles, out of pocket, copay, co-insurance, is it really hard to integrate that and bring all of this together? So these are some explanations that we will explore. And now I'm asking you, so there was the study that looked into that. What are your thoughts? What do you think is the main reason why employees in that firm chose dominated health plans? Let's take a look. I'm curious to see. So some people say complexity. Complexity plays some role, as we will see. Some people say maybe it's just their preferences, how they think about premiums versus out-of-pocket expenditures. Maybe you shouldn't really aggregate them, or maybe people process these elements differently. And we have almost 40% to say maybe it's insurance competence, that people have a hard time integrating these different plan parameters and plan choices. What does the research tell us? So menu complexity certainly plays a role. If you have a side-by-side comparison of plans, most people find that helpful. It makes it easier for them to come up with a comparison. Surprisingly, there was research on that showed if you show annual versus monthly premiums, it doesn't really make a difference. And you would think, well, annual versus monthly premiums should allow you to make a better comparison and to see costs versus benefits more clearly. It didn't have a large effect. And also there was almost no effect of reducing the size and the attribute complexity. So there was only a moderate effect. Some of that seems to be like how you display the option, so that did have an effect, but the number of possible attributes and the different combinations that you had, that only had a moderate effect. So if you do smaller menus where people only choose out of maybe 3 or 4 options as we had it, in many cases you still find a preference for dominated plans that would have allowed people to choose something where they can save money. Now, what about the preferences versus insurance competence? Well, studies have looked into the role of providing additional information and additional explanations. And what they found is that this helps tremendously, and it helps people to better understand plan features, the implications of plan features for cost sharing for out-of-pocket expenses. So it's unlikely to be really driven by preferences. If it's your true preference, you like the plan C better than A, then additional information shouldn't really move you away from that preferences if this is what you truly want. But if your choice of C versus A is driven by having a hard time understanding insurance and processing plan information, then additional information should make a difference. And what the study found is that this additional information reduced the choice of dominated plans by 2/3. Okay, and this is a large effect, comes out very significant. So the low insurance competence explanation seems to play an important role, and I mean that's one of the reasons why we have this webinar here. Now, what are things that you can do to help with that? So think about what makes a good teacher, what makes a good instructor. So tools can help. And there was some other research that showed that insurance for the average consumer with an average amount of education, average consumer, insurance is harder to understand or much harder to understand than you think. So there was an incentivized survey approach where they looked into that, and they found that almost 50% had a hard time determining costs. What that means is if you give them the features of the plan, deductibles, co-insurance, out-of-pocket, all these parameters, and then medical expenditures. So this is what your healthcare bills are in the year. Can they figure out what their out-of-pocket is? And 50% of individuals failed with this task. They couldn't do it. And 65% of individuals, they could not answer comprehension questions. So telling them if this is your healthcare expenditures in that year, and there's 2 or 3 plans, can you pick the most cost-effective one? 65% of individuals could not do that. And keep in mind, this is when they know what their healthcare bills are going to be, what the expenses are. If you give them the exact information, no uncertainty, you strip off all the uncertainty. It's really just, can they integrate the different plan features? Do they understand how they work together? And then also, and that's important, so 33% of people, they made choices that are inconsistent with their preferences. So they said, well, this is the maximum I would really be willing to pay for that lower deductible, for that additional coverage. But then when they made choices, they did something that was inconsistent with what they said earlier. So this is a problem because it means that surveys can be difficult if people have a hard time processing insurance information. What are interventions that help? If you project total health costs on the different scenarios, this is what helps people. Graphical tools, visualizing plans in different graphs and charts, this is what helps people understand and see these differences and what different features do. Also have plain language definitions of cost sharing features with simple examples that people can relate to. This is something that helps, and then comprehension questions, walking people through the process. So these are tools where we have evidence they can help people make decisions. And if we implement these tools, people stay clear from dominated plans and they choose plan options where they can realize some savings. All right, so that already brings me to the end of our webinar. So where do we go from here? So most consumers, they find insurance complicated and hard to understand. And one general piece of advice that I have for everybody, and that applies to any kind of benefit and any insurance product you might be evaluating, consider all costs and benefits. Don't just look at premiums, don't just look at deductibles, consider all costs and benefits together. Only then do you get a full picture. And then talk about it, ask questions. Lots of people procrastinate, they don't enjoy making insurance choices, they put it off, or maybe they just keep their enrollment choices from the last year, they don't want to reconsider. So try to work with commitment devices. Think about it, think about costs and benefits, make it a puzzle that you want to solve, think about it from a research standpoint. Create and ask visualization. That's things that I always, these are things I always do with the students in the classroom. If there's these features and these numbers, these deductibles, what does that mean? Can we draw that? And how does that relate to the premium that we pay for it? So ask for visualization. A lot of people can make better choices when they see something. And also what helps me a lot is document your choices. So write down what the steps are, how you look at that, what your thought process is, and keep that in a place that you can revisit. These are, I think, some general practices that can help people in their decision making as tools and to improve their decision making in the context of insurance and benefit enrollment. All right, so you could see, I mean, we talked a lot about health plan choices, and there's so much more to it. So we barely scratched the surface, because we could also talk a lot about life insurance, annuities, long-term disability, long-term care, liability, auto insurance, homeowners. We talked a little bit about homeowners and umbrella coverage, and many more other things to consider. And we will have some time for that in the question and answer. And that concludes my presentation for now. And I'm very much looking forward to hearing your comments, questions, and thoughts on this. So thanks everybody for your attention. And with that being said, I'll hand it back over to Ashley. So thanks everybody.
Thanks, Richard. Yeah, we have some good questions coming in. So the first one is from D. Lee Bennett. What do you think drives the low salary employees to pick dominated plans? What does research show? Is it fear, debt, etc.?
So this is a great question, and you might wonder, is it a liquidity thing? Is it that if you have the lower deductible, you know insurance kicks in earlier, and that's going to help you from a liquidity standpoint, so from a budgeting standpoint. In that particular firm, if you looked at the employee salaries, it's really hard to make the case that this is what was driving that choice. And we really have to have dire liquidity needs to find a good explanation for these choices. So people have thought along these dimensions, but it's unlikely to explain that choice from a research standpoint. So I think the whole processing insurance, thinking about costs and benefits the right way, that seems to be more of the dominant choice also for these low salary employees.
And then our next question comes from TJ McDonald. Is there a formula or algorithm you recommend we use to figure out the best insurance to choose?
This is a great question. And when we're looking at these health plans, so maybe I go back in my slide because it's going to be easier to show you in the slide. So this tool here, this is something that I created in a spreadsheet, and that's something that I do with the students in class. So if there's all these different plan features, in the end, how does it all come together? I wish that employers provided that to employees so that they can just look at it and see it. I think it would help a lot of people, and also to give some information. So where actually are we in this distribution? If we're looking at a typical employee, what is it that's the most relevant segment here for most folks? Now, when it comes to our choice here at Iowa, the UI choice versus UI select, I did that. So I have a spreadsheet, and if somebody wants it, you're happy to send me an email, I can send it to you, and you can put in the plan features and see how the curves come out. So I think that might be a good tool. In the sense, I mean, it's not really, there's not a one size fits all formula, because people do have different financial needs. They do have different preferences. So it's really impossible to boil it down to this one single formula that does a good job for everybody. But I think visualization and thinking about costs and benefits, and all costs and all benefits, are important avenues for improving the quality of decision making. So great question. I wish this formula existed. If I find it, I'll publish a great paper, but I think it's unlikely that we will ever get there.
All right, a few more questions are coming in. This one's from Amy Christoph Brown. What does your research say about putting money into healthcare spending accounts?
This is a great question about the healthcare spending accounts. Um, so there's some research on that, and it shows that, I mean, a lot of people use them to some extent. Some people have difficulty using them optimally. So you can use flexible spending accounts or healthcare spending accounts to cover things like deductibles, to cover co-pays, and for certain types of things that you might be using. So a good advice, and that's actually advice that's on our homepage for the Iowa benefits, is to think about your typical healthcare needs in a typical year, then budget accordingly, and then use those flex benefits because these are tax deductible. So there's tax savings that you can realize if you pay for out-of-pocket expenditures with the flex dollars instead of the after-tax dollars. So this is generally a good idea. Do people use those optimally? There's not a lot of research on that. So I think it's an interesting topic for future research. Given what we know from other areas of spending and capital budgeting decisions that people make and insurance choices, I would say no. I would say that most people probably have a hard time making this budget and figuring out how much should they put in, what's a good amount to put in. And then, like with our flex account, if you don't use it, you lose it. It doesn't roll over. So people might be worried that if they're putting too much in, then they're losing. So I think we don't have very strong evidence, but my gut feeling would be there's a fair amount of inefficiency and some gains that people could realize if they force themselves to sit down and do a little bit more budgeting when it comes to their healthcare needs for a typical year.
Okay, this is a bit of a long one, so bear with me. Would you include the probability of significant financial distress and resulting high cost debt when evaluating plans with high deductible, where MOOP may be less than 10,000 K? Also, is there some place we can find probabilities for high impact, low probability events like car accidents or contracting a late stage cancer?
So these are some great questions. I'm gonna so let's talk about the first question first with the liquidity needs and how to think about how debt plays a role for that and people's budgeting constraints. Um, so maybe Ashley, let's look at the first part again of the question to make sure I capture it fully. Sorry about that.
No, that's okay. Would you include the probability of significant financial distress and resulting high cost debt when evaluating plans with high deductible?
All right. So I think for some consumers that can play a role. And there's research that has looked into that. So there's some people who have very little savings on the side to cover unexpected like expenditures, or let's say things below that maximum out of pocket. And this might be a reason that drives some consumers or some employees to these lower deductibles or lower maximum out of pocket limits. And I mean, to the extent that people think about the probability of getting into that situation, that would be a great approach in terms of financial planning and how you think about an overall risk management plan that takes all of these financial needs into account. However, there's many cases where we look at consumers who still have difficulty making these health plan choices and still exhibit a preference for lower deductibles and lower limits, who should be in a position where if they budget accordingly, it should not be an issue. So it might, we had that earlier, there was a question about liquidity. So it might help in some cases, but I don't think it really resolves the whole puzzle why we see it so much. Remember, in that firm, it was 60% of employees, and there were also employees among the high end of the salary distribution who had that preference. And for those guys, we can't really explain it at all. So that whole budgeting and liquidity standpoint should not really play a role, but it might help for some consumers to get a better sense of why this is happening. And some consumers might actually follow a good approach and incorporate these liquidity considerations into their overall risk management approach. Typically, what the research shows us is that usually people with these, let's say, in the more dire liquidity needs or with high debt situations, typically there's a correlation between financial literacy and the quality of financial decision making overall. And in some cases, it might be the explanation why they are in that situation to begin with. So sometimes it can be like a chicken or an egg problem here. So it can go both ways. Now, the other question was about where do we find that information? So one resource that I always recommend to my students is the Insurance Information Institute. The Insurance Information Institute has some great resources and statistics and information about insurance and about, let's say, claims rates and average severities and across different lines and different types of coverages and so on. I wish that in some areas this information would be more available. For example, when we think about the benefits and the health plan choice, so something that I would appreciate when I look at our case with the UI choice versus UI select, I would really appreciate it if we had some information on what are the spendings for the employees and maybe by age. What are the typical healthcare expenditures that we see in this group of employees, obviously anonymized and aggregated? So how should I think about typical costs, high costs and low cost? What's a good range to be thinking about that? But sometimes it can be hard to find that information. Sometimes you find general averages and it might not be representative for your geography or for your group or for your pool, for your employer, for your group of employees. So there's some information that we can find. I recommend the Insurance Information Institute. They have some great resources and that's free and available. But in other cases, it can be hard to find. And I agree that people may simply not know probabilities or severities, so they may have a skewed perception of risk. And obviously perception is reality. So what you think about things might affect your choices, the behavior that we see. So I think that's an important dimension where education plays a role. We have to educate people and get the word out. So again, thanks for joining.
All right, we have time for a couple of more questions. Carla asks, have you done any research on life insurance?
So life insurance is an interesting topic in and of itself. And I haven't done any research on life insurance yet. I have a project that is work in progress with the co-author where we think about genetic information and genetic testing. The question that I told you earlier about the normative framework. So should we allow life insurance companies access to predictive genetic testing information when it comes to underwriting, or should we have policies in place that bar life insurers from that information? Life insurance is an interesting field with a fair amount of confusion among consumers across different types of policies. How do we think about life insurance needs? And there's some general pieces of advice that I usually share with students in my class and that I'm happy to share with everybody. So steps in the process is you should think about how much life insurance you need. So a needs analysis is always a clean approach to come up with an idea. How much do I actually need? Who are the financial dependents? Who is depending on me financially? So that's kind of like a first step to think about that. And then also what are coverages that are in place already? What are savings? Maybe there's some employer provided life insurance that's already in place. So the needs is typically a good first step. And then also what's the best type of life insurance? There's different policies, there's term life, there's whole life. And then among the whole life policies, there's a whole host of different policies. So educate yourself. It's costly. It requires some work to figure out what's differences and what is a good fit for me. And then also shop around, consider the financial strength of the insurer, consider different quotes, and work with a competent insurance agent that can give you qualified advice. One general thing that the research shows is, and that's for many areas of life insurance, we see a fair amount of lapsation. So lapsation means people get a life insurance policy and they don't hold it all the way to the end. Either they forget to pay a premium or they have cash needs and then they can't make the premium payments anymore and then the policy lapses, Or if we have forms of whole life insurance, it might be a decision to surrender the policy to get the cash value and then maybe put it elsewhere, or maybe there's financial needs that arise. And lapsation is oftentimes, I don't want to generalize, is oftentimes to the benefit of the insurer and to the detriment of the consumer, because many of these life insurance policies are front loaded. So there's fees and expenses that you pay for in early years that are built into the premium. So if you don't hold it long enough, it's going to be a bad deal for you. So don't be, as a general piece of advice, don't be too optimistic, and really think carefully about what you need, and think about that before you talk to the agent and before you do the rest of your research, and what you can afford, right? Oftentimes we see what the data suggests. A lot of times people are too optimistic about what they can afford, and then we have surrender, we have lapsation, and in many cases that's to the detriment of the consumer, and things that can be avoided if you're trying to be more realistic, more prudent, more cautious with life insurance. If you have more life insurance questions, please feel free to get in touch with me so we could do an entire webinar just on life insurance, right? It's an important topic, a fair amount of confusion, and a really important one. So there's other research. I'm taking too much time, so I'll shut up in a second. There's other research that shows if we're looking at widows and widowers, then we see a fair amount of poverty among widows and widowers, and 2/3 of that is explained by insufficient life insurance holdings among widows and 1/3 among widowers. So it's really important to consider life insurance. So don't be lazy, think about it for your own good, and think about it smart. And hopefully you got some thoughts here today that can help you in this process.
Well, I think that's all the time we have. Thank you so much, Richard. If you want to go ahead and put your contact information on the next slide, I know you have that. So I just want to quickly thank everyone for attending today. If you have any other questions, please feel free to contact Richard. His information is on the screen. When the webinar ends in just a moment, you'll see a quick survey. We'd be grateful if you could share your thoughts and help us make future webinars even better. Watch for a follow-up email of today's webinar. It will contain a recording, and feel free to forward that to others and share all of this great information that Richard has given us today. And as always, the Tippy webinars are posted to the Tippy College of Business YouTube channel. As Interim Dean Amy Christoph Brown mentioned, our next alumni event will be on Wednesday, December 9th from 4 to 5 p.m. Central Time. We'll be hosting an alumni panel discussion with Tippy grads that are currently working in the sports industry. Panelists from the NBA, NFL, U.S. Tennis Association, and other areas of the industry will join us for a conversation moderated by Iowa's Director of Sports and Recreational Management Program, Dan Matheson. So on behalf of the Tippy College of Business, thank you for joining us today. Thank you again, Richard, and everyone have a great rest of your day.